Hello, welcome to Arise News. You're watching the Global Business Report. It's Money Monday. Rhoda Sodiri here. We're in Lagos, Nigeria's commercial capital, where the men are. Okay, let's get into the first headlines. Talking of money, U.S. stock markets losing over $5 trillion over the last 3 weeks. What is the equity strategy going forward? We have a special guest to discuss that. More money, China announcing plans to vigorously boost consumption and spending in the second largest economy in the world. More money, Ethiopia, the AFDB, African Development Bank, partnering on a $7.8 billion airport. It's supposed to be the largest in Africa. And speaking of money, men in Lagos, the commercial capital, spending about 661 billion naira on intimacy. We'll get into that report as well. Global Business Report, do stay tuned. All right, let's begin with the U.S. markets. Look at this massive figure here. Over the last 3 weeks, the U.S. stock markets have lost about $5 trillion in market value. They have tariff worries and a lot of uncertainty. Consumer sentiment has soured. We have a Federal Reserve decision later on this week. We'll see if this is going to impact that decision. Let's look at what Scott Bessent, who is, of course, U.S. Treasury Secretary, had to say over the weekend about the market meltdown in the United States. He says, I've been in the investment business for 35 years, and I'll tell you that a correction, market correction, are healthy. He says, and they're normal. I'm not worried about the U.S. markets, kind of echoing President Trump. He says that if the U.S. focuses on tax policy and deregulation, the markets will climb. Let's get more on that with Sam Jurrens, who joins us from Oklahoma City, Oklahoma, bright and early. 5 a.m. in the morning. Sam, thank you so much for joining us. He's, of course, the CEO of Even Heard. Sam, is there a bottom to this market? I want to read you a quote from the head of Morgan Stanley in investment. Let me put up what he said on the screen, because he thinks that there's still further to go as far as the markets are concerned. It's from Vishal Kanduja, and he said, we don't think that we've seen the bottom. Volatility will be high, so there could be a little bit more downside before there's clarity from the policy side. Do you buy into that? Have we seen a bottom, or there's more, further to fall?
Yeah, good morning, Rhoda. It's good to be on with you again. I think he's got a good point. What he's really looking at is, in normal downward swings like this in the market, you typically have, at least if you look at what's known as implied volatility, where the VIX of the S&P 500, you typically have a spike. Most people kind of call that the fear indicator to show some kind of panic in the markets. And honestly, for how swift this move has been, it's been one of the most orderly sell-offs I've seen, which, kind of shows you there's no actual panic in the markets. It could be more of an adjustment from, last time, I was on with you, we spoke about the excesses in a lot of areas of the markets. Some of those have come out. To me, not a concerning amount yet, because, if you look at some of the high momentum names, I would say a lot of those were some of the areas that were hit the hardest. Something like Robinhood, a financial brokerage here in the U.S., they were up 75% in February. So within the first month and a half of the year, they were up 75%. Now, they're up 5% or so. You see a lot of similarities in the momentum side with names like Carvana, Sprouts Farmers, that have had these huge swings higher and kind of the air getting filled or taken out of them in such a short period. So I'd say it's not a concerning trend to me at this point, but it is, it is alarming how fast the market's moved in terms of speed without having the volatility indicators spike as well. Last August, that downturn, volatility hit one of the highest levels in history, whenever the, yen carry trade was kind of unwinding, and it was very little discussed, which was kind of more alarming that there was so much panic in the markets then that no one was really paying attention to. And so we definitely don't see that, and agree in that standpoint that you don't see that panic yet. But several other indicators, I could probably give you one that shows you it's the bottom and one that shows you we've got more to go. So, and volatility would be one of those that says, this may not be necessarily the bottom yet.
All right. Now, what's your reaction to Treasury Secretary Scott Bessent's comments over the weekend, saying he's not worried about markets, it's just a correction? Well, what do you think about the fiscal authorities not paying too much attention to markets?
Honestly, that's a great point. It kind of fills in everything not said from your first question is, that this is also normal in terms of pullbacks. It hasn't been anything excessive. I mean, you could just look at a chart of the S&P 500 over the last decade, and you can barely even really notice this downturn. So it has been swift. But yeah, I would agree. It is, healthy for markets. They are volatile. Stocks are risky. We spoke about, previously a lost decade is overdue. But at this point, it doesn't necessarily look like the, confirmed start of one.
We've had the FOMC meeting this week. We're going to be hearing from Jerome Powell on Wednesday. You think the Fed holds steady, makes no changes, or do you think they'll be pushed into cutting? What do you expect?
As of today, yeah, I don't see any justification for cutting. The market would have that opinion as well. It's, I think, priced 99% of no cut, so for them to hold steady. When you look at inflation is still elevated. It's calmer, but it's still elevated. The unemployment side hasn't really moved much in terms of giving them reason to be concerned. So I would be very shocked if we saw anything other than them holding steady.
Now, so I'm going to guess that you don't think the U.S. economy would be heading for a recession then, in terms of, or maybe even stagflation with the way consumer sentiment and other indicators have been pointing, or some of the chatter about the markets.
Yeah, it's interesting to be living in this time. You can study similar periods in history, but it's always more exciting to be in it. And when we look at technical recessions on paper, a lot of the things that are happening policy-wise in terms of, Elon Musk has quoted, they're trying to target 4 billion a day in spending cuts. And if that is true, I don't see how, GDP doesn't go negative. And it's not that it's a bad thing, especially for America has been a little bit fiscally reckless. And so it's healthy for the country long term, but short term, really dependent on how the market digests that. And maybe that's what it's digesting right now. Maybe it's realizing, hey, GDP is going to dip negative because government spending is being slashed so much, over this next 12 months. And maybe it's pre-pricing that in. And so whenever we do see negative prints, the market's not going to care. That may be, a possibility. But I would say, if we do have a recession on paper, in those terms, it would be less concerning than a true, economic downturn.
I've been waiting to get your thoughts on the tariff back and forth. We've got more coming April the 2nd. We've got retaliation from Canada, retaliation from the EU. So do you, I guess maybe tying this to the first question about how the markets are going to move, do you anticipate more market turmoil or possible negotiations before April 2nd?
It's difficult. I know we really spoke about that in December. From that standpoint at that time, it was from a position of, well, this is more of a negotiation tactic, where it really seems like with the, creation of the External Revenue Service now for America, it seems like the administration's focus is to actually make this very permanent. So where it ends up settling out is, anyone's guess. It's not helpful whenever, headlines are, constantly changing and, we put them on one day and take them off the next day. Especially I can't imagine being some of those businesses directly infected, in the U.S., some of the manufacturers literally send parts, to Canada and back, and then to Mexico and back before you actually have a finished product, So for them to navigate that is got to be a nightmare on a daily basis. I mean, you can't make 30-day decisions that actually take, 3 to 5 years to make. So it's difficult. You got to look from their perspective. 4 years from now, it could be a totally new administration that absolves the External Revenue Service, and so it's very difficult to say. I would say, as the country as a whole, the markets as a whole, American wise. There's not much impact, but whenever you zoom into specific industries, like the auto industry as an example, they exempted a lot of that currently just because I don't know how they would survive with this many tariffs and retaliation against them. But as far as other businesses, I don't see it having any meaningful impact on them.
So considering where the markets, I think the futures are pointing to a downside for the indexes, the Dow, S&P, and so on. So what's the strategy? I mean, what are you telling your clients at Even Her? Do you buy the dip, you cycle out of equities into money markets or fixed income, go for cash? What's your short term? I guess in the short term, moving into long-term strategy for the markets.
Absolutely. So I'm highly biased towards equities, even in downturns. And I would say that's been one of the most surprising moves of this last few weeks was utilities and consumer defensive absolutely spiked during this. So another way to say that is it seems capital is aggressively rotating out of high growth, more momentum related names towards that utility defensive sector. A lot of the utility side that is more conservative, not really a part of the AI trend trade, if you will. So you've seen a severe rotation into that, and that's what we've done. We also short securities as well, and so we feel like there's plenty of opportunity and always will be on both sides for higher and lower.
All right, now I want to ask you about the rest of the world. Defense stocks in Europe are on a high. China stocks on Friday closed at a 3-month high. We've got the, MSCI price index for the U.S. and then global ex-U.S. and then Europe. So U.S. there down 4.3%, MSCI World ex-U.S. up 7.2%. This is year to date. MSCI Europe up 13%. I know you said you're biased towards equities at a time like this, but are you looking international? Are they appealing to you at all?
Absolutely. It's been over a decade. Even if you zoom out, this international outperformance has been relatively small in terms of a longer term perspective, but in the short term, it's been massive. And so we've definitely, taken notice of that. We trade U.S. exchange traded stocks for the most part, but there are ADRs which have international exposure. And if I would pinpoint one area as well that did incredibly well under this current administration on their first run was China. And China, has been an area that has seen very suppressed valuations, which from time to time isn't unusual. However, when we look at the AI related trend that has really fueled and carried the American markets for the last couple of years, it's unwound in terms of the construction side, in terms of the investment in the infrastructure in America. And I think the majority of that has been, if you look at these AI processing, if you go custom to them for API related transactions on their servers, China is so far ahead in terms of costs. It's 80% cheaper. And DeepSeek was one that, they had some news that kind of roiled the markets, but they will also process their model on their own servers, and they'll do it 80% cheaper than you can anywhere else. And they claim that's at 80% margins on top of that. So from that perspective, I don't see how anybody catches up. I think China becomes the AI processing nation of the world, just like they, tried to have their manufacturing dominance through the 90s and early 2000s, which has waned some, but I think they're going to be focused on, robotics and AI in particular. But you do see outside of that, Europe has stabilized and begin trending higher, and that's from pretty suppressed levels. In a valuation basis, most areas were half the valuation of America. So I think it's only it's only a matter of time before you see some of that capital kind of rotate and transition there. But yeah, I think there's a significant amount of opportunities internationally that are finally moving, and you could start putting them into the momentum buckets. Germany in particular as well. You've seen some strong performance there too, and so I think there's significant opportunity outside of U.S. There always is. It's just in this case, Argentina was really one of the only regions that had significant upside, where now we're starting to see it, in Japan, across Europe as well. Some other areas, Canada's not performing well, but some other areas are. But in particular, I'd say China would be one of the most interesting areas. What you saw in October with their initial stimulus, markets kind of rallied excessively and then came back to their previous levels. But since the beginning of the year, they've really been taken off again with various headline news of I would say AI focused in general. But there's definitely plenty of room to run there, at least especially on a valuation basis.
Sam Jurrens, CEO, Even Heard, thanks for joining us bright and early from Oklahoma City, Oklahoma. Always a pleasure talking global markets with you. Thank you so much for your time, Sam.